recording. Okay. Let's do a quick review where we were, and then let's push forward and finish this up. First off, my apologies again. We are going to meet in person next Monday, and I know that's the Monday before Thanksgiving. It'll be a nightmare driving, and I just didn't want to break the little rhythm of the class. 3 lectures, then problem sets, 3 lectures, then problem sets, and but that wasn't done to torture you. That was just you know to keep with the way things kind of settled up. So we'll do the best we can. I do want to go over as many of those problems as we can get through. And the problem set is due next Monday at 7 o'clock before class starts. So please work with your groups and so forth. For those of you that sort of just kind of like whatever, it'll get done or what have you, please take it seriously. Please work with your groups. Please discuss what you're doing. Please really try to make it count this time. Every little bit helps, and it may be extra credit, but the idea is to give you extra credit to learn what you're supposed to learn. So please take it seriously. All right, so we've been talking about how does a bank fund its balance sheet. So the bank makes money here by lending loan, but they have multiple ways of funding that loan. So one way of funding that loan is with deposits. So they can lend long and borrow short, and borrowing short, they can use deposits. Another way of borrowing short, as we found out, was to use the repo market. So when they use the repo market, this here repo rate, that's kind of like the short rate, and depending upon how illiquid the collateral is that they're using to get the repo loan, they may not get as much depending upon the size of the discount. So again, just to be clear, the bank is lending long and borrowing short. They're either using deposits or they're using the repo market. And now we're going to talk about interest rate swaps. All right, so that's 3 ways in which they can fund a loan short. And the reason they have to worry about that is because they're worried about their duration gap. All right, so they know that the loans, they're going to get repaid generally at a slower pace than when they have to repay their loans. All right, so by using deposits, hopefully the deposits are still in the bank, and people every month continue to get their direct deposit and pay their bills, so the bank doesn't have to worry about deposits disappearing. The banks can again use the repo loan, and they can just say, well, I have this illiquid loan, I'm going to use it as collateral for a short-term loan. I'll lock in at the repo rate. And the other thing that they can do now is they can use a swap. So we can lock in a swap, and we can use a series of short-term rates. Now, here's one of the differences between the repo and the swap. With the repo, we have to use the collateral. With the swap, we don't have to use the collateral. We're just going to say, the notional collateral, or the principal amount, this notional collateral, but we're not going to exchange the principal. So with the repo, I short the collateral and long the futures contract. Here, I don't have to do that. So there are 2 ways to think about the pricing of a swap. All right. So we're going to 2 ways. Number 1 is we can say, here's a fixed rate loan with a coupon, and I'm going to compare it with the floating rate plus the swap rate. So if this is a 2-year loan, then it's supposed to equal a 1-year loan plus the value of the swap. Okay, so that's one way to think about it. And then if we wanted to value the swap would be the difference between the two loans. So that's one way to do it. Another way to do it, since you all know what a long and a call and a short put is, I want you to go back to put call parity. So I like teaching stuff that you already know rather than reinventing the wheel. So if you go all the way up here, notice we have a long call and a short put, and K is the strike price. And therefore, if you have a long call at strike price K and a short put at strike price K, then this is the synthetic position, or the synthetic long forward position. This is buying the this is like a futures contract. It's a long forward. So now you've learned that early on in the course. Now we're going to take that same principle and apply it here towards the end of the course. Right here, the swap value. All right, so again, we'll have the present value, the notional amount, but what we're going to do is call the ceiling and the floor going to be that strike price. That's going to be like the K up in that earlier graph. So if the spot price is lower than the strike price, then you will get paid the difference in the interest. If the floor is, if the spot price falls below the floor, then you pay the other person. So you're exchanging interest payments, and what you're doing is the other person is accepting the variable difference, and you're locking in because you are worried about your duration. So you're trying to lock in the all right. So you're worried about funding risk, and so what you want to do is you want to lock in this green so that it's not so up and down and variable. All right, you're trying to stabilize that duration gap. You're trying to lock in. So if you can lock in at the strike price K over multiple periods of time, then you've kind of, reduced the fluctuation in your short-term rates, and you can better predict what your profits are going to be. So let me spell this out in an example for you. All right, so let's say that you have a $10 million loan that you're trying to fund, or $10 million worth of loans, and you want to get into a swap agreement with another bank or an insurance company or some other financial firm. So you're going to calculate the coupon. At the time, the spot rate is 7.5%, and that's going to be the strike price. So you want to lock in the 7.5%. Okay. Now, the floating is going to change with the spot rate, and we're going to use that SOFR. That's replaced the LIBOR. So SOFR has replaced the LIBOR. And the floating rate is going to change with the spot rate. So what I've done is I've given you a bunch of new spot rates, and therefore you're going to multiply this by the 10 million, and it's going to give you a new floating rate. And then, like I said, we know that one definition of a spot rate is the difference between the fixed and the float. So that's one definition. So when you come here, this is the fixed and this is the float. So that difference is one definition of the swap. That's one way to do it. The other way is to do it this way, where you have the spot rate, which is in this case, 0.735 minus the ceiling, which is the strike price, 7.5, and then you just take that difference here. You take the 0.75 minus the spot and plug it in, and that gives you your net right there. So there's two ways you can do it. You can find the floating rate and come up with these values, or you can just subtract it from the spot rate, because this is the strike price, this is the K. This is that K that was in that previous graph. And then you can subtract this from the K, and that just gives you the net cash flows right here. So if you're using this equation up here, you're using this equation up here, all right? And you're taking the max or zero here, or the max and the floor there, right? Basically, the put is in the money. That's when A makes an extra interest payment to B. Over here, the call is in the money, so B makes an extra interest payment to bank A. And they just keep swapping the differences between the strike and the floating. You know, if the put option is, if the put option is in the money, then bank A pays. If the call option is in the money, then bank B pays, or bank A receives. All right. Does that make any sense before I go to this bottom graph? I won't talk about this until I'm sure we're all on the same page here. So I'm entering into a swap agreement. I'm locking in the future price of 7.5%. If interest rates go above 7.5%, I'll pay the difference to my counterparty. If they go below, if the spot rate goes, okay, hold on. The bank A receives money if the short rates are above the strike price, and he pays money if it's below. All right, so he wants to lock in a 7.5% payment. If rates fall below 7.5%, he'll pay the other party. If rates fall above 7.5%, the other party pays him. And he's gotten into a 2-year swap. So he's lending long and borrowing short. That $10 million might be for 5 years. It could be for 10 years. Who knows? But he's locked in 7.5% for 2 years. And a swap is defined as adding a call and a put option, with the put option being negative. So does that make sense? Let me see. I got a question here. Sure, I'll explain it again. All right. All right. So I'm lending long and borrowing short. Where am I? Yeah, I'm lending long and borrowing short. Now, I can do this one of two ways. I can borrow short month to month to month to month to month, and I can hope that my depositors stay with the bank, or I can get a repo loan and lock in the interest rate for that next period. So that's one way to do it. The other way to do it is to enter into an interest rate swap and lock it in over several periods. All right. And when I lock it in several periods, instead of one futures contract, because a repo, let me compare it with the repo so that you know where we're going with this. Yeah. So with the repo, I short the loan, the illiquid collateral that I have, and then I long a futures contract. So that's one way to do it. That's the repo agreement, is kind of like a short the collateral and long a futures contract. That's kind of like the repo. And in effect, I can do it that way, or I can get into where are or I can get into a swap contract where this was the long futures contract from this previous graph here. That was, yeah, boy, right here, this long futures contract from this previous graph right here, right? That's the repo transaction where I short the bond and long the futures contract. And this here is showing again the long futures contract, which was from above. So I can do it like that. That's for the repo. Or I can do this multiple periods. I can create a long futures contract over, let's say, a 2-year period for 8 periods, which I'm doing here. So I come down here to this graph here, and this is long futures, long futures, long futures, long futures, long futures. Here's 8 long futures contract where I'm doing a 2-year loan every 3 months, and I'm locking in the 7.5%. So the strike price is going to be 7.5% over 8 periods as opposed to just 1 period. So if I do a one futures contract, I sort of do well because with the futures contract, yeah, here it is. With the futures contract, I have locked in over this 1 period. That repo rate is for 1 period. That is a 1 period lock, and that is what's I'm gonna pay when the collateral is delivered back to me and the loan period is over. So this is just over the life of this short-term loan, whereas the swap contract is a sequence of futures contracts. So it is a bunch of future contracts over multiple periods. And with that said, again, we're not going to exchange the underlying collateral. That we don't do. So we're just going to take a sequence here of synthetic combinations. They're all, synthetic positions of long calls and short puts. And so we don't need to do the repo collateral thing. We're just going to lock in at this strike price, but now we are going to run into counterparty risk, which I'll talk about in a second. Let me finish answering the one question, because I'm just saying now, since we locked in 7.5, since 7.5 is going to be our strike price, then when the spot falls below it, I'll take that difference, because I am upset only if I have to pay more than 7.5. If I have to pay less than 7.5, all right, that's great. But since I'm in this futures contract, I'm going to swap that difference in interest rates with my counterparty. Likewise, I don't want to pay over 7.5%. So when interest rates fall above 7.5%, I'm going to swap that with my counterparty. Specifically, my counterparty is going to pay me. So I want the counterparty to pay me when the difference when interest rates go above 7.5, and I'll pay the counterparty when the counterparty guesses correctly that interest rates are going to fall below. So again, it's that example about Southwest Airlines locking in the price of oil over several years, maybe, or several periods. They know that the holiday is coming up. They don't want to pay more for gas. Now, if it just so happens that gas falls below what Southwest Airlines thought it was going to be, then they will pay their counterparty. But if the gas goes above, and Southwest guessed correctly that they needed to lock in the gas prices, then they will get paid the difference. So they're just locking in a sequence of futures contracts over multiple periods of time. And that's what banks do with loans. When they're lending long and borrowing short, they know for a fact that they're going to need these loans for multiple, they need a short-term loan for multiple periods of time, not just one period, because they know that short rates follow a random walk. So they enter into a synthetic position to lock in short rates over multiple periods of time. All right. Now let me see what this is either bank A's or B's. If it's negative, bank A pays bank B. If it's positive, bank A receives. Is the profit of the person I'm not following. They're not really exchanging the principal amount. They're just changing the difference in cash flows. So um, so in your question, when you say who's borrowing, that may be difficult to say who's really borrowing, because no one is really borrowing with the swap as much as they're just exchanging cash flows. If they were okay, I'll give me a second, Miriam. If they were uh, um, borrowing, one person would be the lender and the other would be the borrower. But rather than that happening, what they're doing is saying, if I were borrowing, I would have to pay more if uh, or I would pay less if rates fell down, and vice versa for the other counterparty. So what they're doing is saying, I'm going to take a side where I think interest rates are going to go up. So if they go down, I'll pay. And if they go up, you pay me. And vice versa for the counterparty. The counterparty thinks interest rates are going to go down. So if they go down, he's or she is correct. And if they go up, then he or she has to pay. So I think you asked a good question, Arthur. A swap person is not a person in a swap is not necessarily, we're not looking at a borrower and a lender. They're just exchanging cash flows. All right. Now, Miriam, where does the 3.5 come from? I just gave that to you. I just told you that was quarterly to make the math easier. So instead of 12 months out of the year, a payment is made every 3 months of the year. All right, so that was in the problem. Okay. All right, are we good? Can I go on to the next? Yes, you're right. Well, the short call and the long put is the other half. So right. So yeah, we're looking at it having a long forward contract, because I'm pulling the interest rates away if they go up, but the other one has a short futures contract uh, when they go down. So yeah. And in fact, to answer your question, okay, yeah, exactly, Arthur. All right, so to answer your question, James. Right here. So if Bank A has the long futures position, then Bank B has the short futures position. So you can say that they're locking in the interest rates, and so that's uh, where they're going with this. But now here's the problem. All right. Let's say in period 7, you're in a swap agreement and you want out. Okay. Well, is a futures contract is considered a combination call and put. So we're defining a futures contract as a call and a put at the same strike price. All right, so a futures contract, I don't necessarily own the asset. I have a synthetic position. I have the exposure to an asset that I don't necessarily own. All right, so let me, right, that's the whole idea with options. Options are like leverage. So I have claims to the profit streams, or I can put the loss on someone else without owning the option itself, the underlying itself. Yes. All right. So now I want to get out of this swap deal. Maybe Bank B in particular is saying, you know what? Bank A is actually making off like a bandit. Bank A is getting paid 4, 5, 6, and now it looks like Bank A is going to get paid again in 7. So Bank B wants out. Well, all Bank B has to do is add the payment and then um, um, do this same calculation, the difference between the fixed and the float. That's the swap value. So they take the bond and get the fixed amount. This here floating one is like a 0. So you get the way this 187 comes up is you have this payment here and this payment here. So those are your two coupon payments, and we said it was a $10 million notional value. All right, so notional principal of $10 million. So by taking the fixed payment, the fixed payment and the principal, that was the value of bond B. But this is like a 0, so it's just the 195 plus the 10 million. So that's the payment for the float, and the difference is between the fixed and the float, and that's the value of the swap. If Bank B wants out, if Bank B decides that he wants out of this swap, all he has to do is subtract the present value from the floating value and pay the difference, and he's good to go. Just pay the value of the swap in period 7. The other thing is probably what I think James asked is he can form a third counterparty to take the opposite position. So he agreed to take the floating position with Bank A, but Bank B could take the fixed position with Bank C. And therefore they could perfectly offset like that. Then the other thing is Bank B could just default and not pay Bank A and just say, well, I'm not paying you. We're done. We're done here. And that's how come swaps have a counterparty default risk, And that's the very reason the problem set that you have for the term project, the regulators are concerned when banks get into swaps with other banks. They want to make sure that a bank is protected against the risk, the counterparty risk that the other person in the swap won't pay. And then finally, we have swaptions, which is an option to enter into a swap when things are going your way, and the option to terminate it when things are not going your way. So, how can a losing party get out of a swap? These are the four ways in which you do it. All right. So, um, anyway, interest rate swaps is just another way in which a bank can lock in the interest rates over a longer period of time. And if they're lending long and borrowing short, they can lock in the short rates for a little while and go with that. All right. So before I go into the securitizations, let me see what we got. No, the notional principal shouldn't change. Only the interest rates. All right. At least in the problems that I give you, we're not asking for a bucket of blood. We're going to stick with bond mechanics, and we're going to keep the notional value fixed. So remember, if I'm doing a repo, then I need collateral, and the collateral can change because the par value doesn't have to equal the spot value. So that's a very real concern, and maybe you're thinking of that. That's that basis risk, right? So that's the basis risk when the right here, yeah, when the current spot rate is no longer equal to the initial par rate, and then you're subject to a margin call, and we certainly don't want a margin call. All right, but with the swaps, we're just going to agree on what the notional value is. That's not going to change. All right. And so the only difference you have to really worry about, though, is counterparty default risk. You do have to worry about the other person paying you. You don't get a margin call if you're not. The only time you get a margin call is if your collateral drops in value. But with a swap, you don't have the collateral. You just have the notional value. Okay. So if you're using the collateral, yeah, and you have to worry about a haircut when the collateral drop is less liquid, or the underlying collateral drops in value. So that's exactly when you have to worry about a margin call, is when your collateral that you're using for the loan drops in value. That's like if you buy a house and you get a mortgage, if that house drops in value, it's possible that the lender might say, you know what, your house has dropped in value, so we want you to pay a little more money. Now, that rarely happens, but I'm just saying a lender has the right to come in and take an appraisal of your house if they think it's dropped in value, and said, you know what, the value of the house has dropped so much, you're going to have to reduce your mortgage balance and give us some more money. All right. Now with a swap, the no collateral is changed. With this, just priced on a notional value. Okay. Okay. Beautiful. All right. So now we've locked in our short-term rates. All right. We've locked in our short-term rates over a certain period of time. Let us, what do we want to do? Let's say I want to separate the prepayment risk from the default risk. All right, so let's go back up here. Now, remember, this is where we started. We had a bank. The bank is lending long and borrowing short. They have default risk, prepayment risk, and funding risk. We have said that we're going to use a swap to lock in the funding risk over several periods. So we got that. We used a repo when we didn't have enough deposits. All right. And then this loan here was the collateral for our repo. So a bank can use the asset as collateral for a short-term loan that it's funding. If you buy a stock on margin, that means you didn't pay cash for the stock. You borrowed the money to buy the stock. Same way with the bank. If the bank makes a loan, but they're lending long and borrowing short, when they borrow short, it's almost as if they're borrowing because they don't pay for this outright. They wait for you to repay your loan. They borrow the money temporarily for this loan. So they're trying to fund the loan, and then they use the swaps to lock in the rate. Well, now we're going to talk about using a swap to separate the default risk from the prepayment risk. So what the bank is going to do, the bank is going to keep the prepayment risk, the risk that the borrower pays early. But what the bank is going to do is sell off the default risk, the risk that the borrower pays late. And how are they going to do that? They're going to buy bond default insurance, and that is a fancy way of saying a credit default swap. So if you've been hearing on the news people talk about credit default swaps and how dangerous they are and all that kind of stuff, that's because they haven't had Econ 477. Okay. So Bank A wants to retain the coupons and prepayment risk, but Bank A wants to sell off and detach the default risk or the credit risk. All right. So what Bank A is going to do is pay an insurance fee so that if the borrower defaults, if that's the credit event, either the borrower fails to make a payment, they default, you get a credit downgrade, something happens, then basically what the protection buyer is going to do is pay 56 basis points of an insurance premium, and then the protection seller will assume the default risk. All right. And here's the thing. The insurance company assumes the default risk without having to purchase the bond. All right. So the bank can keep the illiquid asset in its portfolio, and the bank can continue to receive the coupon payments from the loan. All right. All the bank has done is said if the borrower pays late, then you, protection buyer, the insurance, protection seller, you reimburse the protection buyer. All right. So I'll keep 3.5%, and I will give the default risk, the 56 basis points, to the protection seller. And the protection seller is going to agree to that because the protection seller is going to say, hey, gamma is close to zero. We're going to assume positive convexity risk because I know gamma is either deep in or deep out of the money. If I purchase your default risk, then I know for a fact that the borrower probably has good credit history. So I will go ahead and take my 56 basis points because I don't think that borrower is going to default. And that is how come banks can actually sell the default risk and keep the prepayment risk. So let's say I'm the bank. I had that illiquid loan. Well, what I'm going to do is I'm going to keep the prepayment risk. I'm going to keep the loan. All right. So I'm going to keep the loan. I'm going to keep the prepayment risk, but I'm going to sell the default risk to the insurance company, who the insurance companies are used to, you know, like automobile insurance or fire insurance. If your house catches on fire, they think that it is a small chance that that will happen. They don't need the liquidity like a bank does, because everyone goes to the bank on Friday to cash their check. When it's directly deposited into their account, people are paying bills or doing whatever they do. So banks need liquidity. Insurance companies don't. So they can use credit default swaps, and they can use derivatives such that they don't have to purchase the illiquid loan. They don't know, insurance companies don't underwrite default risk, okay? But they can go and provide insurance, all right, to the bank, and they can purchase the default risk, and the bank can retain the prepayment risk. All right. And this is kind of what Freddie and Fannie does. If any of you take the Econ 478, we'll explain how securitizations can be structured in such a way that you can take a loan and you can split the risk of paying early into the risk of paying late. And that's really what happens sometimes when they say banks are selling loans. They can sell the entire loan, or they can split the loan up into its risk components, keep one risk, and sell the other risk. And so how do you price bond insurance? You price it as if it were a put option. I told you at the beginning of the course that insurance is a put option. So how do you price any insurance? You price it like a put option. All right, what do you think you misread? Question here? Okay, I'll come back to it. No, now remember, now we're not talking about the interest rate swap. We're talking about the credit default swap. So the interest rate swap, that was a different swap. We're now talking about the credit default swap. So before, we were locking in short-term rates and we were dealing with funding risk. Now what we're doing is we're splicing, separating prepayment risk from default risk, and we're going to price the default risk, and we're going to do so using, we're going to mimic a put option to do it. Okay. All right. So the seller is providing insurance. When you go and get automobile insurance, you are going to an insurance company. When a bank wants to sell their default risk from a loan that it's made, they're going to a bond insurance company. So they have what is called bond insurance. Sometimes they call them monoline insurance companies, but all they do is buy default risk from loans. Just like Allstate and State Farm and all of those guys will buy homeowners, they'll sell you homeowners insurance and purchase the risk that your house gets in a flood or catches on fire, just like they purchase the risk that you might get in an automobile accident. Bond insurance purchases the risk that a loan will default. So the protection seller is some kind of an insurance company, and the protection buyer is the bank. And this is not CDs. the bank is buying credit default swaps. So bank buys a credit default swap. This CDS here stands for credit default swap, not the CDs that you would, as a depositor, go into a bank and buy a certificate of deposit. That is not that. This is credit default swap. So the insurance company sells credit default swaps or a put option, and the bank buys a credit default swap or a put option. So you can literally think of insurance, bond insurance, as the bank buying a put option. All right. What risk on the same side of the balance sheet? So we have prepayment risk for one, and we have default risk for the insurance company. Well, the default risk only appears here. This here, the insurance company still has to, they're going to collect the premiums and they're still going to try to fund um, their assets just like the bank is funding its assets. Now, insurance companies, you could even put the contingent liabilities here. So that's a fair question. I should probably, if I'm going to put an insurance company, I should probably structure what their liabilities look like. But I didn't want to go too deep in the weeds about that because another bank, this could be Bank of America and this could be Wells. Maybe Wells Fargo could decide to purchase some default risk because Bank of America is able to reach some clients that Wells may not be able to reach, or a small bank may be able to reach constituents that a larger bank won't, so they could trade the risk around, but they still have to fund their assets. If you buy Starbucks stock, if you buy Apple stock, whatever stock you buy, you either got to pay cash for it or you got to borrow the money to get it. So the funding risk, that's fine. But all we're saying is that the bank used to have a balance sheet that looked like this, where it was one loan that had both default and prepayment risk. Now we're saying the bank has the same one loan, but they've gotten rid of the default risk, kept the prepayment risk, and I guess I don't need to put this here, so you can ignore that. Right. No, offload the default risk from this bank and give it to this person who sells the credit default swap. It's just like a put option. So someone buys a put option, that was this bank, and someone sells a put option, that's this bank or institution. So it's just a buying and selling of a put option, right? No problem. So if the law of one price holds, all right, then the credit default premium that you pay, so it's like the put premium, should be equal to the difference between two bonds. All right. So the par rate minus the present value. If the present value of a bond deteriorates because the person is about to default, then the par should be greater than the present value. Okay. Conversely, because bond prices and interest rates are inversely related, if the par rate if the risk-free rate is higher than this par rate, then that spells problems as well. So that means, oh, I'm sorry, just the opposite. If the this would be like junk bonds, right? Because the rate has to be so much higher than the risk-free rate because it doesn't trade. So let me see. Let me see if I can clarify that up. Did I put that graph up here? Oh, that's a different presentation. That's the one that I give to the staffers. Okay, I'm sorry. I can get it to you later or something like that. But basically, a junk bond should trade at a higher interest rate than the risk-free rate, reference rate treasury. So the more credit risk, the lower the value of the bond, but the higher the interest rate, and the premium should reflect the rise in credit risk. If credit risk is going up, then the credit default swap premium should go up. So it's some kind of a credit spread, and there's multiple ways in which to define this credit spread. You can define it with the bond prices, or you can define it with the interest rates. Either way, the premium should equal the difference between the riskiness of the bond and the risk-free bond, or it should be zero. So I'm using the same pricing definitions that we used when we were pricing puts earlier in the course. All right. And we're saying that the credit spread minus the futures price or the derivatives price, that's going to be our definition. These should move together. And if they don't move together, then that basis means that the basis has separated, and that basis should tell us something. That it tells us that the law of one price fails, and that should signal something to policymakers, that should signal something to regulators. All right. So what are some things that we are concerned about when we look at the credit default swaps and we look at the basis risk on the balance sheets of banks? All right. Well, one thing is, theory tells us that banks should be the ones funding assets. When banks start selling risk off of its balance sheet, that tells us that it's expensive for them to keep the risk on their balance sheet. So banks can reduce its capital requirements when it looks as though it's getting to the point it's too expensive for them to keep the risk on their balance sheet. And so today we are beginning to see where a lot of times banks will originate loans, but instead of keeping them on their balance sheet, they're selling the default risk off their balance sheet left and right. And that is because they are experiencing the cost to own the loan on its balance sheet is more expensive than the cost to sell the default risk. And that has some regulators worried that now that the banks are selling so much default risk off their balance sheet, they don't know who is going to be in trouble. Is it going to be a pension fund? Is it going to be an insurance company? Who's going to actually have the risk if banks aren't keeping it on their balance sheet and selling it off to people? So this is a real thing that we look at the basis risk when we're doing bank regulation to see what's going on. Conversely, when basis is negative, that means that the derivatives are more liquid than the asset itself. All right. So sometimes we're seeing that people don't even want the default risk as much as they want to hold the credit default swap derivatives. So they're like, I want to make money selling insurance, but I don't want the risk. So that's saying that the underlying asset and then the derivative have different liquidity characteristics. So they're not perfect substitutes. So I don't want the underlying asset. I just want to sell the insurance and make money off of that. I don't think municipal bonds is a perfect example. A lot of states, Virginia, Maryland, whatever, they issue municipal bonds. They don't necessarily default on their municipal bonds. They just stop collecting your garbage, or they'll stop. They won't fix your sewer or your pipes, but they do pay the investors in their municipal bonds. Well, in that case, the municipal bond is illiquid. No one wants to hold municipal bonds, but they're willing to sell you insurance against the state of Maryland or the state of Virginia defaulting on their municipal bonds, because they know that the state of Maryland or Virginia just won't pick up your garbage, but they're not going to default. So in that case, selling puts is more valuable than holding municipal bonds. So we pay attention to the difference in the basis, so that we can get a sense of when we see banks making certain decisions, then we kind of have a sense of what's going on in the market. And all we're doing is comparing the underlying asset with the derivative, and how well is it replicating itself. So up here, right, when we say the derivative should mimic the underlying asset, and if it doesn't, the basis is screwed up, then when we see that the basis is moving in different directions from the derivative, that tells us that when we look at the bank's behavior, we're saying, well, how come the bank isn't treating assets and derivatives like perfect substitutes? Something has gone wrong, because if the value of derivatives and value of assets were similar, then banks would treat them the same. But the fact that banks are not treating them the same is telling us that basis is falling apart or broken down. All right, let me read this question. Oh, good question. There are some municipal bonds, I'm trying to think, like the state of Illinois, that has a rating of junk. And even though because that rating is so low, some insurance pension funds require that the pension fund buys insurance or something like that, or they are saying that the people can't hold it. So yeah, the yield on a junk bond is really high, but you almost have to cut your yield off and buy some insurance if you want to hold it. So yeah, that's one reason. Also, it's still considered, who was it? Was it Illinois, or what was that state that it's been a while, and I don't want to spread rumors, especially if you have relatives in certain states. But it was a state that I think was late making a payment. And so, in fact, I was reading a little bit about today about how some states are securitizing their tax revenues and making sure that the people that's supposed to get paid first before the state can even touch those tax revenues. but off the top of my head, I can't remember that. I'll try to grab that article tomorrow and read up on it so I can get y'all up to speed. All right. So, well, the bank is buying a credit default swap. They're selling their loans. And for some of the loans that they're keeping, they're buying the credit default swap to sell off the default risk. And that's because the capital requirements are so high. Okay. So, right. Good. So, what we're talking about really is deviations from the traditional banking model. So, just like I told you before, economics is we tell you how the world should work, and then we try to figure out what assumptions have been violated and why are banks doing something differently from what theory says they should do. So theory says that they should hold loans, all right, and fund them on their balance sheet by lending long and borrowing short. So this is basically what banks should do. They should get a loan. It has default risk, prepayment risk. They should lend long and borrow short. The idea that they're splicing and dicing loans into separate risk components or selling the loan off their balance sheet outright, that's a deviation from standard theory. So let's again think like an economist. How should things work? And then ask ourselves, why isn't the law of one price holding? Why isn't this theory working? Why isn't it, if people are rational and engaging in rational behavior, why are they doing something that doesn't seem rational? Or is it rational and we need to figure out what constraint changed? We still, as economists, want to assume that corporations and firms are trying to reach the highest indifference curve that they possibly can. They're trying to maximize their well-being. So now we're going to look at some of the decisions they make, and then we're going to ask ourselves, why are they making these decisions? Okay, so in this slide, we're saying we're going to depart from the traditional banking model because there may be more bank regulations like capital requirements, changes in monetary policy. The Fed started increasing short rates, so lending long and borrowing short. Borrowing short became more and more expensive. So now we're going to talk about how banks are responding to this and why they're holding more derivatives. Okay. Yeah, I'm about to explain all of that. All right. So let's say a bank goes out and originates a bunch of loans. All right. Now, do you remember this slide from above? Because I'm again teaching you the same stuff that I taught earlier in the course. Right here. So we said that the depositors, if a bank has loans, the depositors get paid first, and then the preferred and common shareholders get paid second. Then we said the same thing happens with a business. All right, they have accounts and receivables, and then if they make loans, they get paid first, and then preferred and common shareholders get paid last. We're going to apply those same concepts to securitizations down here. And in fact, I think I asked y'all a securitization question. But at any rate, we're going to get a whole bunch of loans. All right. And then what we're going to do is we're going to create senior paper. We're going to create mezzanine paper, and we're going to create junior paper. And what that means is the people who buy the junior paper, they are going to get hit first. If the loans default, then they eat it first. And then after they get wiped out, the mezzanine folks eat it. And then after they get wiped out, then the people who made loans to the pool, they eat it last. Well, when you buy a securitization, you will be asked a question. Let's say that you want to go out and buy a bunch of securitized business loans, small business loans. And you're like, I don't want to buy the loan. I don't want to own the loan. I want to buy paper that is linked to the loan. Well, the person's going to ask you, do you want to buy senior paper? Do you want to buy mezzanine paper? Or do you want to buy junior paper? And you will get to choose which order you want. The people who buy the junior paper get paid the most because they're taking the most risk. The people who buy the senior paper get paid the least because they're taking the least risk. All right. So if Freddie Mac or Fannie Mae bought a ton of mortgages and then they go and issue mortgage-backed securities, that's going to be senior. And if they issue what they call credit risk transfers, that's going to be junior. So you can buy prepayment risk, or you can buy default risk from them. If you go and buy, I'm trying to think. I don't want to throw out too many technical terms. But if someone buys a bunch of small business loans, they'll ask you if you want to buy senior, mezzanine, or junior tranche business loans. So yeah, it's not the specific assets. It's just the position on if these assets were to default, it is the order of payment. Who loses first, who doesn't lose as much, and then who loses the least. So if you remember that one question on problem set 1, where the junior people own the assets, they got paid last. All right. And when the securitization, they eat the losses first. In the previous problem, the creditors got paid first, right? Here, the creditors, they incur losses last. All right. These guys get it first. These guys get it last. So we're just saying that the people in the senior tranche position are going to, they're not going to make as much money as the people in the junior tranche. But if something goes wrong and these assets stop performing, the junior folks who made more money are going to eat losses first, and the senior people won't. So it's the same kind of thing. It is the positioning of, and that goes to the earlier question. I forgot who it was who says, well, why do I have to buy insurance for municipal bonds? Well, some pension funds say that if you're going to hold a municipal bond, someone needs to be junior to you. So that's why that fund has to then go out and buy a put option, because the person who sold the put option is junior to the pension, the rest of the pension fund, in the pension fund. So sometimes you can get what is called a credit enhancement if you can get someone junior to you. Well, it just depends on the fund. I won't say it's a regular, I won't say that requirement necessarily has to come from a government agency. It could be that if you're in the plumber's pension fund, then maybe all of the plumbers that are in that fund voted to have someone that was they said, if you're going to buy junk bonds, if you're going to buy low rated bonds, then we want you to go out and get someone junior in the fund to protect us, give us some protection. We don't mind taking some risk, but we want some protection. And it doesn't necessarily have to be a state regulator that said that. It could just be uh, the members of that pension fund. They send it up to a vote, and that's how the people voted. Okay. Oh, I've been scrolling up and down, and my apologies. I could have just gone here. So this is the way the world should work: traditional banking, where we hold the loan in portfolio and we lend long and borrow short, or we hold the prepayment risk for the mortgages. We hold the senior tranche for business loans. Maybe we hold some treasuries so that we can be GFC repo lenders, um, or what have you. But instead of holding whole loans on the balance sheet, we hold derivatives that are linked to whole loans. We don't keep the whole loan. We either hold derivatives or we issue derivatives. And then that allows us to reduce our duration gap, all right, because we're not keeping so many illiquid loans on our balance sheet. Read it. These were the tranches right here: senior, mezzanine, and junior. These are the tranches: senior tranche, mezzanine tranche, and junior tranche. All right. So, right, right. So is holding this guy is holding senior tranche CLOs. He's not holding the junior and the mezzanine. So this bank isn't getting paid as much as if the bank was holding all of these commercial loans. They would have an entire whole loan on its balance sheet. Instead of the whole loan, they only have the senior tranche. They only have, if this is a bunch of commercial loans, a bank is only holding the senior tranche, and they only have that much risk on their balance sheet. They don't have all of the risk associated with the commercial loan on its balance sheet. Right, right. They don't have to buy portions of each. They just buy the senior tranche level. In fact, and this is in law, the Volcker rule that was passed in 2000 and, uh, 2010 made it illegal for banks to hold anything below the senior tranche unless it was in um, poverty neighborhoods. So they could, buy a food bank or make a loan to provide food in a poverty community or something like that. But by and large, banks are told that they cannot hold uh, mezzanine and junior tranches. And the capital requirements are outrageous if they even try it. So the regulators don't want them to do it. And Congress has said, we don't want you holding equity shares. We only want you in the senior position, because senior position is when you are more like you're behaving more like a lender and not like an investor. We don't want banks investing in businesses and voting and all of that. We only want banks lending to businesses, and then they have no say in the business decisions. All they have to do is make sure that the business is sound enough to repay the loan. Yeah, after the 2008 mortgage crisis, there was concern that when banks were securitizing mortgages, uh, that they were, well, I take that back. The Volcker rule really, in truth, was just a jab against the large banks. Members of Congress were pissed because they thought that the banks caused the crisis, which that's a whole nother lecture. And what they did was they put that law and said that banks were trying to get around Glass-Steagall. So the Volcker rule says, this time we mean it. We don't want you trying to create some kind of derivative that allows you to get around the regulation and do what we told you that you weren't supposed to do. So Glass-Steagall was passed in 1933, and it separated bank investing from traditional bank activities. In doing that, it, it, let me finish this sentence and then I'll just tell you it's a lot more complicated. The Volcker rule comes back and says, we want to make sure that you are making loans and you don't have any say in investment decisions. So it was kind of, to be honest with you, populism, kind of like people didn't understand banking. They didn't understand what happened in 2008. And so Congress passed a law and they thought that they were making things safe. But I wrote a paper on that for Congress, and I had to choose my words very carefully. I'll see if I can find it while I'm entertaining the other questions here. So I'll look for that in just a second. But anyways, any other questions about let's see, our CLOs? Maybe, how about this? Give me one quick second. All right, I'm gonna try to put something in the chat here. All right, so just bear with me because I'm old. Let me hit paste and hit send. Did everybody get that? So let me good. Let me see if I can share the screen for a second, and then we'll finish up this last slide. Just give me a second here. I want to stop sharing. Damn it, stop sharing. And then let me share screen again. Okay, there you go. Now here's what I want to show you. All right. So this may actually be a good application of the real world here. Lenders generally fund their longer-term assets with a continuous sequence of shorter-term borrowings. They're lending long and borrowing short. They profit from the spreads between the loan prices or the difference charged on the loans, the longer-term loans, and the rates that they pay to depositors. You got it. Depository institutions may fund their loans using recurring deposits, and depositors are expected to be repaid their principal and receive interest at regular intervals. All right. But depositories are not limited to funding loans only with deposits. All right. And so I give an example of a participation loan. And a participation loan is a joint loan between banks. And usually when banks create pools of mortgages, usually it's not just a single bank. Multiple banks may put together pools of mortgages, but one bank acts as the sponsor of the participation. So on that balance sheet that I showed you where there was pools of loans on the asset side, let's assume that that bank acts as the sponsor and they're doing it with some other banks. When they do that, then this is a trust formed to hold the debt. These are all um, bonds and loans. And I told you we're going to use loans and bonds interchangeably. All right. So they create this big structure because, and I explained to you that the CLOs are like asset-backed securities, mortgage-backed securities, student loan-backed securities, commercial mortgage-backed securities. All of these are that structure I just showed you with the senior, the mezzanine, and the junior tranche. All right. So by creating a CLO tranche and creating securities that are senior, mezzanine, and junior, that's another way of funding loans in addition to using deposits. All right. So I don't have to do it with that. I can do it like that and do it with deposits. The only problem is that looks a lot like a hedge fund. All right. And so a hedge fund, you know, manages a fund and goes out and either gets investors to be equity shareholders or they go and get loans or what have you. And so this Volcker rule that came out was designed to prohibit banks from engaging in proprietary trading. And it also wanted to make sure that they structured these participations so that they weren't acting like a hedge fund. All right. So I'll let you guys go ahead and read this if you want to. The version that was published, I have an original version that I liked even better, and they some internal politics. One of the people reading the article, I don't know, maybe he was just a poopy head, but he wouldn't let me say it the way I've been teaching for 30 years. I know how to make this thing clear. And he just thought that the members of Congress were too stupid to understand. And I'm like, well, they got phones, they got emails, they know how to call me if I say something that they don't understand. But he wouldn't let me say it the way I wanted to say it. So if y'all are interested and want that version, you can have that too. But anyway, let me stop sharing that. Let me go back. We got to do one more slide. And we're going to see share files. Oh, no. I don't want to share those files. Oh, no. I got it's an exam I got up here. I can't be showing that. Share application screen. That's right. Here we go. All right. So anyways, banks don't have to use deposits or they don't have to use repos. Deposits and repos, that's kind of like traditional banking. But when they create all of these structures, all right, they're creating these different tranches. And like I say, you have a bank that's acting like a sponsor, but he's got his buddies together and they're all working together to create these pools, and then they're issuing these securities. A lot of members of Congress thought that that was getting around the rules that they wanted. And but banks are getting to the point they're holding less and less retail loans, and they're using these fancy funding structures, and they are derivatives because the definition of a derivative is a financial instrument that is linked to an underlying. So this is linked to an underlying. These are linked, the senior tranche is linked to an underlying. These are all linked to underlines. So they're all derivatives. And banks are increasing their use of derivatives. They're increasing their use of interest rate swaps. They're increasing their use of credit default swaps. And that's where the term project comes in. Okay. Last but not least, I didn't expect to go over my little paper there, but I guess it was relevant. Okay. We're doing covered interest rate and exchange rate parity. So again, the law of one price, I should be indifferent between borrowing and lending at either the domestic or the foreign interest rates as long as everything is fully hedged. All right. All right. Let me come back to your question in just a second. Just remind me. Let me finish this and then I'll come back to your question. All right. So here we have the spot rate, the forward rate, the one that that's all right. That we have the domestic rate, the foreign rate, and all we're going to do is we're going to say what should the rate be. So we're going to take everything, be it compounding or no compounding, and we're going to get the implied forward exchange rate. And that reminds me, for your problem set, I'm asking you a question. I think it's about the implied repo rate and all of that. When I ask what is the implied foreign exchange rate, what's the implied repo rate, I'm asking you, what does theory say the rate should be? And if you find in the real world that the rate is not what it theoretically predicted, then you have to kind of back out what assumption failed. Why did the basis no longer hold? Why is there less liquidity? Is there a haircut involved? So basically these practice problems, and you can do this, do it under compounding and no compounding, just plug and chug. I give you the interest rates and I give you the spot rate. Plug and chug. And why and then which one would they want to short and which one would they want to long? Well, we lend long and borrow short. So when you do that little practice problem, it should be straightforward and easy. At what rate do you want to make a loan in, and at what rate do you want to borrow in? How are you going to arbitrage? All right. And a forward exchange swap is just a sequence of synthetic combinations, just like the interest rate swap was. So here's your basis, and apply the same concepts that we've been talking about above to the problem here. Now let me go back and answer this one question with regard. Oh, they can merge, but they got to get permission from the regulators in order to do that. But that's always been true. So we're not saying that they can't merge. It's just that they cannot engage in structures that would give them the kind of like the same influence as if they were equity holders. They have to engage in transactions where they are treated as a senior creditor and not as a junior shareholder. So for one thing, the deposit insurance, FDIC doesn't want to have to go and reimburse depositors because the bank was acting like a hedge fund as opposed to a lender. But as we're seeing over time, it's getting harder and harder to compartmentalize people into, are you a lender or are you an equity? I mean, well, it, it let me put it this way. It's harder to look at some of these structures and ask someone to splice and dice. It's like, is a hot dog a sandwich? All right. Well, you could say, well, yeah, it's a piece of meat between two slices of bread. Well, give me more. Well, a hot dog is a little bit different from a hamburger, which is different from peanut butter and jelly. And you have to really get into such specificity to make sure that someone is staying within the law. You are allowed to be a hot dog, but you're not allowed to be a sandwich. Well, you got to hire a team of lawyers to make it clear that you're a hot dog and not a sandwich. Well, the world is getting kind of complicated. If that's the quickest way, the best way I can answer that question, you know, where it makes sense. Okay, so I know it's a lot there and it's a lot to digest. I know that the problem set 2 is going to seem really, really tough, but if you understand these slides and you understand problem set 2, I promise you the final will not be as hard as that. But we got to get you to give me a bucket of blood where it doesn't count against you so much here. And then when it does count, you'll be in good shape. In what context? Um, yeah, I was mentioning it within terms of trying to distinguish between the senior and the junior positions and all of that kind of stuff. Um, Trying to make it look like the bank is in the senior position and not in the junior position when they're creating these trusts. Um, I'll have to, you'll have to let me think of a way to use that there. The only analogy I can think of here is just remember that a swap is very much a synthetic position. So when I'm asking about hot dogs and sandwiches, um, what we've done so far is when we talk about replicating positions, we use um, when we use puts and calls to replicate stock. That's kind of like, is it a stock or is it a replication of a stock? Is it a hot dog or a sandwich? Where do we do that? Here? Yeah. Put call parity relationship. So we can do that right there. So that's what derivatives do. Um, let's say that the SEC, the Securities and Exchange Commission, they don't like it when people short sell. Okay, I won't short. I won't. Where's the short sell? Yeah, I won't short sell. What I'll do is I'll sell calls and buy puts, and I'll replicate synthetic short sell. So you can use derivatives to replicate positions even if you don't hold the stock itself. So that's how come down here when we said I don't want to hold this illiquid asset on my portfolio, but I'm happy to hold the default risk. So what I'll do is I'll sell a put, purchase the default risk, and I'll hold the risk, but I don't have to hold the asset. And the put has an expiration date. The credit default swap has an expiration date. So that works out great. And since I know that the gamma default risk is usually um, lower price, I'm only going to make 56 basis points, but I know that gamma is close to zero, and so it's not going to, go in and out of the money back and forth with these volatile swings. So I already know when I purchase default risk that the probability of it suddenly switching from being out of the money to in the money is really low. So I'll just sell puts and collect the premium on that. So I'm going to replicate the risk by selling puts, but I don't need it on my balance sheet. The same way with Bitcoin. People ask me, am I into cryptocurrencies and stuff? And I'm like, well, I'm not into cryptocurrencies, but I would much rather buy and sell derivatives where the underlying is cryptocurrency so that way I can get exposure to the speculation, but I don't have to own any of that cryptocurrency on my own balance sheet. I can use derivatives and I can set myself up a put spread, a call spread. I can set up a strangle or a straddle or all these different kinds of positions, and I don't have to actually own the asset. So I can replicate the asset. So that's kind of what we mean with the derivatives. And I guess in some ways, not that Congress fully understood it, but they were concerned that banks were using derivatives to replicate positions that they told them in 1933 that they didn't want them to have. So that was what was going on back then. All right. So other questions?
I have a quick one for you if you can hear me.
Sure.
Hey, so aside from The Big Short, do you have any movies that you like that kind of go into this topic?
No,
Anything
that Big Short was a bunch of it it was not as accurate as I would have liked for it to have been.
That's what I've just learned from today. They do.
I'm sorry, you went out.
Oh, yeah. If you can hear me now.
Now I can hear you. Yeah.
Yeah, it's like the scene with Margot Robbie and Selena Gomez. Everybody remembers they explained CDOs and credit default swaps. But yeah, I'm learning now that they kind of dumbed down, especially the credit default swaps and stuff like this. But I was just wondering if there was like anything that we could watch, like even a documentary or something that would kind of something. But there's really nothing like that too much that you know of.
I'm not trying to push my own reports, but if you would read my boring reports for Congress, which Congress doesn't read them, so I don't expect you to read them either. But I explain and go through different things that happened and explain. Actually, in the real estate course, Econ 478, I kind of explain a little bit more about what happened. We really had a glut of houses. We increased the supply of housing, and when the supply curve shifted down, house prices fell. And when house prices fell, the put options to default were suddenly in the money to default. So basically, here's what happened. We allowed people, yeah, here we go. We allowed people to buy houses with zero down. So in doing so, house prices only had to drop a little bit, and then the put option to default was already in the money. So one of the big fixes is to stop letting people use two loans to buy the house and avoid putting down any kind of down payment. Make them at least put down 5% down payment or something, 3.5%, 5%, whatever. But zero down payment means that the borrower has an incentive to walk away when the collateral falls below the loan balance, right? So if the collateral falls below what you owe, you're underwater because you're paying for more than what you owe, and as a result, the put option to default is going to be in the money, and that's what happened. So when people say, oh, it was the greedy securitizations that caused it, if everyone had got a 30-year fixed rate loan but had to put 0% down, then we'd have had the same outcome. So the outcome has nothing to do with necessarily how the house was financed. Now, that doesn't necessarily mean that there was some folks in there that wasn't fully disclosing risks and reporting stuff and all of that, but they it was it's just that everybody wanted to buy a house and thought that they were buying it at a low price and that everybody was going to sell that house at a higher price. And what happened was is builders followed the laws of supply and demand. When house prices went up, what did the builders do? They built more houses. That's the law of supply. Yeah, I'll build more if I can sell it for more. Well, the thing is when they started building more, it was the supply curve that shifted to the right. And when the supply curve shifted to the right, house prices fell. And again, if the collateral falls below the outstanding debt, then the embedded put option to default goes. Now, notice I explained what happened in 2008, right? Using boring economics, and I didn't blame a boogeyman. The political parties, the Dems blamed the greedy lenders, the Republicans blamed the Community Reinvestment Act and said it forced banks to make risky loans. That none of that, neither party was correct. That's not true. It's just a matter of supply and demand, and then the embedded uh, put option was in the mortgage. And so the moral of that story: make everyone put down, 3.5 or 5% down payment, so that when house prices fall, they don't have an incentive to just walk away. So that's what I would say. And it wasn't because people use derivatives, and banks were using derivatives to manage their duration risks. And it wasn't because of securitization that caused the crisis. That, in my opinion, is a misunderstanding of what happened. But I'm just an old man with an opinion.
Understood. Absolutely. I follow with you. One thing there
Mhm.
too, wasn't it like variable interest rates? Like some people sign mortgages. I think my parents, one of them.
Yeah, some people had interest rates because interest rates were beginning to go down and house prices were going up. So it was just beautiful. I mean, if you're talking about rational behavior, maximizing your own best interest, why wouldn't you? So now, if people had locked into the fixed interest rates, um, they could have refinanced again, but that would have been expensive to just keep going back and refinancing. So they just chose the variable rate, and they thought that everyone sort of thought that they were all gonna, you know, everybody was going to buy a house, everybody was going to rent it out, and everybody was going to consolidate all of their student loans, car loans, all of that into the house. So let's say you buy a house, the house goes up in value. You get a cash out refinance. You pay off all of your other debts, and mortgage debt is tax deductible. So you can reduce the interest off your mortgage debt. So it makes sense that everybody would buy a house, try to wait for it to appreciate, pay off their debts that are not tax deductible, and then, like I say, get an adjustable rate loan. And, you know, as interest rates keep dropping, your payment is going to drop. It's going to adjust and drop. I mean, it's a win-win until you get a glut of houses. And then in California, for example, I kid you not, there were brand new construction, and because house prices had fell so much because they had such a huge inventory, the builders were knocking the houses down before they even put them on market, trying to stop house prices from falling. Fast forward today, and we're talking about a shortage of affordable housing because the builders remember having to knock down houses because they had too many. So they're kind of scared to um, do all of this building. And then, of course, since COVID, materials have gone up, labor, you can't find anybody to do the work for you anymore. So I think the cost of the house have gone up uh, as well. So, but that's kind of the deal. I got a paper on that too. So I'll tell you one thing about my job, it certainly forces me to write a lot of papers. All right, let me answer this one question for James. Uh, it's hard to outlaw synthetic positions. Um, um, yeah, I mean, that's um, you can combine, you can own this asset, you can own that asset, and you can kind of combine stuff, and that's never going to really go away. Um, that's like saying your doctor tells you you can't have beef, but then you go out and get, mushrooms or some kind of black beans and create a veggie burger or something like that. And you say, oh, wow, this tastes just like hamburger. Now, of course, you're lying. But the point is people can always find some kind of substitute and try to make it as replicate close to something that's uh, being banned. So just if they can do it for food, they can do it for financial risk and positions too. Uh, no, all derivatives, including this credit default swap, is going to have an expiration date. You can't go out and get car insurance forever. Every 6 months, you have to re-up your car insurance. Same way with any kind of call and put option, and the credit default swap is a put option. So it will have an expiration date, and if a bank wants to continue to sell default risk off to some other entity, then they'll have to continue to pay a premium. Now, you can say for so many years you're going to structure that premium, but you're not going to be able to sell default risk in perpetuity. And how do banks offload? Freddie and Fannie don't automatically buy them. You have to meet Freddie and Fannie's requirements. And and interestingly enough, if you are a lender, you originate a mortgage, you tell Freddie and Fannie that it meets their eligibility requirements, and you sell it to them. If they go through and find out that you don't, Freddie and Fannie have a put option. It's called putback risk. And that means that they can take the mortgage you sold them and put it back to you. So when you sell a mortgage to Freddie and Fannie, you also sell a put, which it says that if you didn't meet their criteria, Freddie and Fannie can put the mortgage back on you. They can sell it back to you. So Freddie and Fannie don't automatically do it, but there are so many banks that do not want to hold mortgages that there's a huge chunk. I want to say 60% at least. It's a chunk of mortgage of the U.S. mortgage market where banks originate the loans and then they sell them to Freddie and Fannie. So the federal government is really holding a lot of our longer term mortgages, and Freddie and Fannie are issuing mortgage-backed securities that just have prepayment risk, and the federal government keeps the default risk. And only since the recent crisis has Freddie and Fannie been selling the default risk now to, pension funds, endowment funds, Harvard, Stanford, Yale, hedge funds, and all of that kind of stuff. But that's only been recent. Okay. They do all the time. So, well, to be honest with you, the federal government, in all seriousness, um, if people want 30-year mortgages, then the federal government is going to have to hold the default risk. If like in Canada, Canada has 10-year mortgages and they're adjustable rate. So the lender does not have to deal with the interest rate risk, and they don't have to deal with the default risk for no 30 years. All right, that's something that Americans wanted, and so the federal government has to step in. If you have banks like JP Morgan, Chase, Wells, and all of that that has trillions of dollars in assets, and I'm talking about they got these loans. Where are they? Okay, so these guys have trillions of dollars in assets, just the asset side of their balance sheet. There are some countries whose GDP isn't that large, and of course Freddie and Fannie is even bigger than some of the larger banks. The point is if we have like an earthquake or a tornado or that crisis that rips through the banking system, the federal government is going to have to step in, because who is bigger than Freddie Mac and Fannie Mae other than the U.S. federal government? So when people talk about too big to fail and all that kind of stuff, they really don't understand the magnitude of what we're talking about, and just the magnitude of the federal government. All right. Now, again, if people want to reduce some of the risk that the federal government is holding, then one way to do it is to give up our 30-year fixed rate mortgages. But I would imagine people would run the streets and set buildings on fire if they realized they could no longer get a 30-year fixed rate mortgage. If the federal government stops insuring them. Right now, a bank is not going to hold it and hold that much capital. Remember, the bank has capital requirements. So they're not going to take up space on the asset side of their balance sheet. They would much rather have a commercial loan that they only have to issue for 5 years, 10 at the max, and hold capital against that and splice and dice and sell it off. They do not want these 30-year fixed rate loans. If they can't sell them to the federal government, then they will not do them. Banks will only do about a 10-year loan at max. And banks do not want to sell you a fixed rate mortgage, and then they are faced with these short-term random walk rates. What they want is to sell you an adjustable rate mortgage so that when short rates move, your long rates move, and then banks can lock in their profitability, have more stabilized probability. Right now, if the banks don't use the derivatives, then their returns follow a random walk just like the short rates. So they have to stabilize them using derivatives. So they would rather let your monthly payment fluctuate with the random walk. And since that's not popular, the politicians went ahead and created Freddie and Fannie. And so now the federal government insures that risk. All right, other questions? Now I'll stop recording and then I'll go ahead and answer whatever questions